The S&P 500 closed at an all-time high. Dow Jones pulled back and look where it tagged the area that was prior resistance. Little nice hammer candle with some good volume today. We're going to get a bounce? Well, we will find that out tomorrow. IWM also, take a look where this came. It broke out of the channel and it tagged the back test that we discussed yesterday. Were you prepared to buy? Is this going to roll itself over and continue to head down? Well, we're going to find that out here soon. But so far, this is holding as an area of support. You're watching the Stock Market Brief Show. My name is Michael Silva. Today's episode, to be honest, it might scare you just a little bit. But for those that actually pay close attention, all you're going to be thinking is, ooh, the opportunities. Got a lot to talk about. Let's get into it. Hey, welcome back to the Stock Market Brief Show. We're taking a look over here at all the different indices and how they perform. All right, I'm done with doing that. How did the day perform overall? Pretty flat, right? We talked about the market potentially stalling out, and that's pretty much what it did, other than some underlying stocks. And in order to really understand that, we need to take a look over here at the sectors. These are the 11 sectors that make up the S&P 500. The top two, pretty much everything down on the day for the most part. Healthcare was flat. But really the outstanding, the little shining stars is what? Consumer, discretionary, and technology. Why? Consumer discretionary, we talked about. The top holdings is Home Depot, it's Tesla, and it is, what's the other one? Amazon. And then we have tech, obviously, that consists of Apple and various tech stocks, those mega cap stocks we're going to be talking about today. And that's really what held this market together. So in today's episode, we're going to be going through these charts, and I'm going to be showing you a lot of indicators I might have not shown you before, that it's just a very interesting time. Okay, a very interesting time. You'll see what I mean here. So NASDAQ 100 hit an all-time high on the negative divergence that we were talking about right here on the upper edge of this channel. Here's the heat map of the S&P 500, and what I want to point out here is just look at the sea of red that took place. However, the consumer discretionary and tech names, the big ones, heavy weight on the indice, those ones led the way. They kept the market from really rolling over. Same thing with the NASDAQ 100, as you can see here. If we take a look at this is looking at cap-weighted index over an equal-weighted index, the SPX, S&P 500 over equal weight S&P 500. So it's really looking at large cap stocks, mega cap, Fang Stocks basically, because the S&P 500 is only made up of, 7 to 10 stocks with the highest weighting. They make up for 30+% of the indice. And then you have the equal weight index, which basically is like, hey, everything's valued the same. So I think of that as like kind of smaller companies in a way. And you can see here on the monthly time frame, we talked about this one a little while ago, how it pulled back here, and this is the relative strength line. It started bouncing. So when this is moving up, that means the S&P 500 is overperforming the smaller, the equal weighted companies, and that's what we're seeing right here. So the S&P 500, those mega cap stocks, continue to just perform significantly good. Even on the daily time frame, we had a little inverse head and shoulder that continues to press and break out. So perhaps there's more strength to come from a relative standpoint in the SPX and those big, tech stocks. Here's the just absolute performance of the equal weight right here, right? And then this S&P 500 down here. So as you can see, equal weight actually went down today. Meanwhile, the S&P 500 held steady. Why can that be? Well, just for reasons we just discussed. All right. Now, what's very interesting is if you just take a look at the advanced decline, you have 166 stocks in the S&P 500 that were inclining, 337 that was declining. And then just take a look at this. Even though we've had this many declining stocks, look at the flow. Way more capital coming in on advancing stocks, even though there's fewer than the declining stocks. So just very interesting. What does that mean? Well, that just means that there is a lot of money, a lot of flow coming into these big tech stocks. Now, if we take a look at the signal charts that I like to use and various indicators, this is the NASDAQ advanced decline line, and this is something that I learned on stockcharts.com by David, I can't pronounce his last name. It's not David Keller, but David, I'm not even going to try because I'm going to butcher it. But what is very interesting here is typically the S&P 500 performs very well when these are obviously moving up, right? The 21 and the 50 EMAs are moving up, but we have this pointing down. Meanwhile, while that's moving up, it is diverging from the Qs themselves. And yeah, I changed this to Qs. I said S&P 500, but I meant Qs there. And then you look at the NASDAQ McClellan oscillator, also very interesting. Price action has been, moving up here. Now I put the SP 500 here, but we know the NASDAQ 100 has also been moving up. I got to change that. And then also this has been just declining. So we have a big divergence taking place there. Also, the NYSE McClellan oscillator. This is very interesting. It's starting to curl itself over. Meanwhile, S&P 500 continues to press higher. And this is never a good thing. We talk about this when it dies off and how it can sometimes create divergences. So I wouldn't worry too much necessarily about this unless it crossed down through the zero line, then things could get a little funky. Okay, let's keep moving on. Here's the NYSE McClellan oscillator. We've been talking about this negative divergence up here. This one sold off. Now we're getting some weakness in the New York Stock Exchange. Slightly, right? This thing has been really falling down pretty significantly. So is there more room to fall? I guess we'll find out here soon. Let's keep going. Also to note, S&P 500 closed at a all-time high, which breadth, we're looking at another way to basically calculate the NYSE McClellan oscillator, a different way to look at it too. This is a pretty overextended move to the downside. This is very overextended right here, and that's where I typically look for bounce plays. But even in this area, we've seen bounces in the market take place when it hits those levels. So the fact that the S&P 500, which is very interesting here, the S&P 500 has been moving up. This, for a consistent amount of days, has been heading lower, diverging from what is taking place. What does that tell me? That means the internals are breaking apart. Flow is coming in, though, but just to a very few stocks. So it's almost like a stealth, bear market underway here. NIA, this is advanced decline line. We've been talking about this divergence. This thing fell off of a cliff here. It's getting to that overextended territory. Oh my goodness, things are crazy. If you take a look at sentiment updated, I believe today. It updates every Thursday. This is NIAM, and then we have the RightX below us. And basically all this is saying is we have a pretty overextended reading. This is basically saying asset managers are leveraged bull, right? When you get above 100, I think it's up to 200 is like max leverage bull. And then if it goes to like 0, it's hedge neutral. If it goes to 100, or that way, that's like above minus 100, I guess, would be short with leverage, etc. And then you take a look at the RightX. RightX is continuing to just, where's money flowing? It's still really bullish. Very low reading on the RightX there too. And we're just continuing to press higher and higher in the S&P 500. And this has been a pretty decent contrarian indicator, but we'll see here, are the asset managers right? Typically when we get these overextended readings, what could this mean? It could mean that, the risk is to the downside. So when things flip, you're going to have to see this thing. It could be very dramatic. It could be a very dramatic move when they have to correct. Now, let's keep continuing on. CPC, this is the sell signal. This hasn't updated today, but this is November 17th update. You can see the sell signal is curling up right here. That doesn't mean anything until it crosses this 0.8, and you can see also the light purple line in the back. That is the CPC itself. The black line is the 10-period moving average to smooth it out. And when it crosses up through 0.8, we've seen some sell side, activity take place. Like for example, right here, sold off a little bit, multiple times, like right here, boom, sold off, and various other times. But I talked about that yesterday. Here's another thing that's interesting. Percent of stocks above the 50-day moving average and 200-day moving average. 50-day moving average, 200-day moving average. Been declining. So the percent of stocks above the 200 have been declining. The percent of stocks above the 50-period moving average in the NASDAQ 100 have been declining as well. Meanwhile, S&P 500, the NASDAQ 100 continues pressing higher to all-time high close. So that is another divergence taking place, letting us know that breadth is weak and actually just completely utterly horrible this week, which, does that matter? It doesn't matter until it matters, I guess. This is where it gets crazy. It just continues to get crazy. All right. We had a big new high spike right here on this move, and that was new highs. This thing has been just falling off a cliff. Meanwhile, we just hit new highs. So you would think that we'd have some more support, but we don't. We don't have the support. It's very few stocks. It's the big tech stocks. This is also very, very crazy. shared this on Twitter. If you don't follow me there, you can follow me there. This is new lows. So bear with me, you might be a little confused here. But this is how you look at it. When you have a spike in new lows, typically that means that the market's going down, right? Because you have a lot of stocks in the NASDAQ, right? And if you get a lot, big spike here, typically it means low. Like right here, we had a spike and we hit a little pullback. Right here, we had a spike and well, that was right here at a pullback. What the heck is going on here? Boom! Big, huge move. A lot of new lows taking place. Now, somebody had mentioned on my Twitter, it's because of OPEX. Maybe, but I got something for you. First off, I want to call out this. This has been moving higher and higher, and new lows have been increasing and increasing and increasing. So the internals continue to break down. Also, option expirations, OPEX, it happens, right? But look at a longer term chart. This spike right here, boom. It's its biggest since the pandemic area, right? Just absolutely horrible trash, like just garbage breath that's taking place right now in the markets. If you take a look at this is new high, new low index. This is another way to look at it. Look at, boom, new highs. We've been sinking off a cliff. And this is actually in more of that kind of like overextended territory that I watch. Because typically when you get these overextended moves in this green box here, even here, I have these blue dashed lines. You can see, bam, we rallied, bam, we rallied, bam, we rallied, bam, we rallied, bam, we rallied. That's what we were paying attention to, actually. If you're new to the show, when we had this recent sell-off in the NASDAQ 100, when everyone was flipping their lids, this is it. It's Evergrande. Everything's falling apart right now, right? That's what everyone was saying. I was looking at this positive divergence taking place, and also these overextended readings. I was like, if the NASDAQ breaks this trend line, I think we rip. And we ripped. We headed a lot higher. Well, we're already high. So what's going to happen? I am super confused here as the internals are continue just, melting. They're melting. There's the Baltic Dry Index. This is something that I shared also in previous videos. And all I did was, if you don't know what this is, that's fine. You can Google it. Don't put too much weight on this. I'm just sharing it with you just to show you a correlation. That's it, okay? When the Baltic Dry Index, rips down, it's been a leading indicator for some pullbacks in the market. So for example, the S&P 500 here. So this fell first. Just look at these blue vertical lines. All right. Started falling. Bam, we fell. Bam, we fell. This was going for a while, but the market continued to press higher. Then we fell right here. Boom, continue pressing higher. Then we corrected right here. Boom, then we fell, and so forth. Why am I showing you this now? Well, we've been continuing to head higher. And this thing has been just falling off a complete cliff. Does that mean anything? I don't know if it's going to mean anything. You can't say with absolute certainty. But what I did find interesting was not even that long ago. It was today. Tom McClellan, somebody who's a lot smarter than me by light years, posted a very similar chart, the Baltic Dry Index. And he was basically saying this. He looks at it at pretty much a similar way, just smarter. If the current positive correlation in this leading indication relationship continues, then things are about to get a lot uglier for the stock market. What does he mean? You can continue to read the rest if you want. What does he mean? The correlation, this relationship, the S&P 500 black line has been moving up. That is the Baltic Dry Index has been moving up. So the correlation here has been positive. However, if it continues to be positive, well, the only thing missing from that scenario is the S&P 500 going back down. Well, I don't know if it fall. Yeah, that was a dramatic pullback right there. But that would be the correlation. So if it continues, that means the S&P 500 could get very ugly. However, he did mention that, but sometimes we've seen that the correlations invert. That's totally fine. And then he says, I don't know what to do or what to think about it. And honestly, I wouldn't know the first thing to think about it too if this starts turning over. That's why I'm not putting too much weight on any one indicator. All right. So we talked about the internals of the market combusting. Meanwhile, Fang Stocks is what's holding it together. A lot of flow coming into those individual names, as you probably have seen in today's trading session. This is the Fangman relative strength chart that I put together. We're looking at basically just from up here down, spells out Fangman, right? Facebook, Apple, Nvidia, Google, Microsoft, Amazon, Netflix, Fangman. Those are the big stocks, right? And you can even include technically Tesla. Tesla's a one that I technically should have in here. It's a big wig. But what I want to call out still, relative strength, Apple, boom, shot right through the 50. Nvidia continues to spike higher. Google is relatively flat, but pointing up. Microsoft, new high again on relative strength. Amazon, big spike up. Netflix continues to hold the 50 EMA 2 as well. So it's not like these are weak by any means. They are getting overextended on some daily charts on a few of them, but I just tell you, the relative strength continues to match the price performance. If we take a look at Facebook, we're going to look at these on the 2-hour time frame. I'm going to go through the charts here relatively quickly. Still a possibility for an inverse head and shoulders and a flag pattern. So if this starts getting back above 345 to 355, pow, we can head higher. Okay, so right now as it stands, just flagging, bearish crossover, not doing much, holding that 50 EMA on the 2-hour time frame, okay? Let's just continue on. Here's Apple. We talked about this tight little pennant pattern that was forming and this trend line. It broke out, and it broke out in a quick flash, flagged very quickly, and then hit and closed at an all-time high. Now, careful, right? There's going to be a lot of retail traders that probably chase this up, and you might get lucky. It might continue up higher, especially with this volume to support the move. But if you're looking at this 2-hour chart, and it's closing at an all-time high, it's right here, it's above this. Yes, it can go higher, but it's also getting a little overextended on that RSI. MACD is literally cranking up like crazy, and it's getting extended from the 20 and the 50 on the 2-hour time frame. So I wouldn't be surprised to see this consolidate, potentially pull back a little bit. That would be healthy. But, we've seen some crazy things take place in the overall markets. But, me personally, I don't chase this kind of a move. I wait to see it consolidate or pull back into an area of support, and then I'm ready to fire off some shots. Nvidia, earnings, bam, gapped way up. Started basically pulling back, and it's kind of flagging right here. So this is one to just keep an eye on and watch for either a pullback to close the gap or around this area, or if it starts cracking through this previous high and taking off for a continued run. Okay, so Nvidia, we talked about this pennant, sold off into earnings, right, and then just gapped and rallied, which we've been seeing. Google, we were thinking that this could be potentially one of two things, a head and shoulders pattern, and then the neckline was down here, or we also talked about the possibility of this being a bull flag. Well, guess what? Google finished up on the day, bam, plow, right out of that. That is a bull flag breakout, and we're tagging right here the previous all-time high. So it did close up 1.28% on the day. Are we going to crack through this, or are we going to range trade? As it stands now, we hit here, that support, resistance, resistance. So we got to wait to see if this is going to be range bound, or if we're going to break out or break down. One of the two will come at some point. Microsoft continues to just trek higher, up almost 1% today. And it's clearly trending up in a positive direction. Microsoft's an important one to watch. Huge, huge, huge market cap, right? Huge market cap. And, it's up, how much for the year? It's up like, shoot, I don't even know. Actually, I got to look. But all-time highs, right? Still, and it's continuing to just press higher and higher and higher and higher and higher. So you got to wonder, if this thing starts seeing weakness, that could be probably pretty bad for the markets if the other Fang stocks kind of come down. Now, one thing to watch for is the MACD, bearish crossover potentially, and the negative divergence there on the RSI. And I guess negative divergence on the MACD too as well. All right, Amazon. Last time we talked about this was the diamond pattern. And guess what? It broke out, and that's pretty much a full measured move as the RSI is getting pretty overextended. Nice solid volume on that move as well. Is this something you want to chase? I like to wait to see what happens, see if it consolidates, pulls back, and so forth, or maybe reconnects with the 20-day moving average or 20 period moving average on the 2-hour chart. So very nice strong move overall for Amazon today. And Netflix pulled back slightly, so it's down 1.4%. But in the grand scheme of things, it's still in an uptrend as it stands right now. What's an uptrend? How's that defined? Well, you have higher highs and you have higher lows. So until that changes, until we get a lower high and lower lows, then that's when we need to proceed with more caution. And also to watch, it is still right there on the 20 period moving average and 50 period moving average. We have a MACD that is crossing over to bearish, but it is well above zero at this particular point in time. So that means it could continue to consolidate or stay within this trading range that it's in. So boom, 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 boom. So we'll see here what may take place. All right, let's wrap this up with the conclusion. So chances are you're probably like, oh my gosh, this is like, like a lot, really bearish, and you might be scared, but if you paid close attention, you might actually catch the opportunity within all of this. What's the opportunity? That's what we're going to talk about. Okay, so first off, we mentioned that Fang stocks, they're very, very strong right now. You can do really well with them, but some of them are getting overextended. Now, what typically happens when things start rising up and just flying as stocks? You just think about it, right? Typically, when you get stocks, let me draw it out. When you get stocks that are going like this, no one thinks about them or talks about them. Boom, 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 boom. But when it goes like that, all of a sudden, everyone's talking about it. You get some volume spikes, and then everyone starts chasing until it freaking just blows off, right? And we've seen that in Lucid, and we've seen that in Rivian. So tech stocks, they are getting overextended. Some of them, right? Not all of them, but some of them are running up like crazy, and you're going to get more retail traders. And I know that they're retail traders because you can actually look in to like how it's being traded. So for example, Nvidia, right? Nvidia is, it's traded by a lot of retail, and you can look into Thinkorswim in the options chain, right? And Thinkorswim shows this, and it says traded at the bid, traded or below, and then traded at the ask or above. And look at how many, so total volume on calls, 1 million. Traded at the bid or below, almost 300,000. Traded at the ask. This is people literally just chasing. Like they're not even considering just, hey, maybe between the market. And that's a huge percentage. That's retail craziness for you right there. Where was I going? So yes, as people continue to chase these stocks up, you got to think like Wayne Gretzky's quote, you skate to where the puck is going. So where can the puck potentially go to? Well, that's the question everyone wants the answer to, right? So all I've been seeing here recently was, well, IWM, like we mentioned, that broke out, right? It broke out, and now people are probably getting scared. And while they're getting scared holding their position, they're looking over at big tech shoot up. So the opportunity could very well be here. Does this mean that it's going to crank up and, you're wrong if it doesn't? No, that's not what I mean, but you got to think about it, right? We broke out of a year consolidation, and now we're coming back to back test. Come on. Everybody is looking at this 232 level to 230 range right here, this zone in here. We pull back in here. Does that mean that's a failed breakout? No. Even if it comes down further, no, that doesn't mean that. All right, we need energy. We need financials to start turning around. If that's the case, well, this could be very good. We did have a bearish crossover, but I'm saying that as people start getting out of their positions, as we've been seeing here, taking profits, and we're just back testing, people are going to, where can I go next? And they go to the hot thing. Meanwhile, that's when you can get in early to, where's the puck going? Whatever Wayne Gretzky says, his famous quote. All right, so that's the opportunity that I'm saying to look at, despite the bearishness and the weakness taking place in various stocks and sectors. Now, what can really throw off tech? Well, we've been saying this. It is the 10-year yield, right? Yields. Watch yields. Okay, continue to watch them. And if this thing fires off, we've seen the correlation, the rate at which this changes to the upside, it puts a lot of pressure on big tech. And as it stands, this is an inverse head and shoulders. If this thing wants to fire off, this thing could fire off, and we'll see. If it does, it hasn't yet, right? This could sink down, and that could be still beneficial. Might still continue to see flow going into just tech. Also, to note, still inverted, right? The 30 and 20 right here, you can see that on the spread. And if you think that doesn't matter, which people might be like, well, what does that even mean? It's a good indicator. It's been known as a really good indicator, as a leading indicator to know when an upcoming recession may be. And it's not necessarily the 30-20. The 10-2 is more popular, right? The 35 and so forth. Those ones are a little bit more, important. But this is still, any yield curve inversion is, you don't want that. And then this is the 35 down here, and the 35, starting to roll itself back over, right? It's not near inversion yet. What we would need to see for an inverted yield curve of the 35 is this black line here get under this purple line. So it's still quite a ways away. I did a video on that. Now, I want to show you the last time that this inverted. The last time that this went from positive to inversion was right here and right here. This was leading into, so 2006. Then we rally for a couple more years right into where the financial crisis was. So it's a lead. It led as an indicator. Doesn't necessarily mean that that's going to happen, but it's something to call out because guess what? Bam, bam, we're inverted. And we haven't been inverted since when? Well, basically 2009, mid 2009. Pretty much once we started getting back out of that was the bottom of the great financial crisis. All right. So what does this all mean? It means to be careful. Like always, don't start chasing things up like Rivian or Lucid. Be careful, wait for pullbacks, manage your risk. That's the only thing that you have complete control of, right? What you put in, how much, what you buy, when you buy it, how much of it you buy, and when you sell it. That's all I got for you today, everybody. Have a wonderful night.